My name is Andrew Stotts of the Valuation Masterclass, and today we are going to have a live presentation of one of the students in the Valuation Masterclass bootcamp. And let me just go over that detail briefly. His name is Putti-san, and he has been working many, many hours on this. And the company he's going to present is Fastenal, and you'll get to learn all about it. If you have questions, feel free to ask. Remember that the next boot camp starts in 68 days, and you get a $1,900 discount now if you type BC23 live at checkout. Remember, we have a 7-day complete money-back guarantee, so if you don't like what you see, then you can get a refund. Let me bring him in here. Hold on. All right, Putti-san, are you ready?
Yes.
Pretty exciting, huh?
Yeah,
I think
actually.
you've worked, as we were just talking earlier, you said you've worked about 200 hours now in the whole Valuation Masterclass bootcamp, and you're halfway through. How many hours do you think you worked, let's say, over the last few, like five days or so on this report, in the finishing touches?
To finish this report, right? Actually, I think it might be over the half to maintain and to fix it in this 2 week.
Right. So you mean 100 of the 200?
Maybe actually, I'm not sure about it because I'm just always bring it to the blog every week.
Yeah.
After learn, so I need to change my model every week that I'm learn.
And have you ever written a research report before, like this?
No, but I'm just have only the risk management projects,
Right.
but doesn't have it in this way.
And have you ever heard of the company Fastenal before this?
Oh no,
Yeah.
actually.
So you're really starting fresh. And I think that's an exciting point, is that you've gone from zero to where you are today.
Yeah.
So I'm sharing the screen now, and so in just a minute I'm gonna leave here, and then as soon as I leave, you just start, okay?
Yes.
So I think it's time now, and I am going to leave, and so you can start now.
Hello, I'm Putti Getwong. I'm glad to be present my Fastenal report, equity valuation, and here is the Fastenal value play driven by industrial supply and vending. I initiate coverage on fast with buy recommendation based on a target price of $47, implying an upside of 14%. My target price is derived from the FCFF based valuation using the WACC of 6.5% at a terminal growth rate of 2%. And I would like to highlight you all about the three key stories. The targeting $10 billion revenue by 2028. Digital vending locks in 68% of sales, creating a competitive moat, and capital spending secure future revenues. For the risk part is economics factor and strategic executions are core risks. Intense competition threatens Fastenal's profit margins and supply chain disruptions. And let's moving on the three stories. The Fastenal transforming from a simple distributor into a fully integrated cost-saving supply chain partner. So it's difficult to replicate. They also have 16 distribution centers across North America with growing 200 million into Eurasia divisions. Fastenal doesn't just sell products, it sells a complete on-site vending and automated inventory solutions that make it incredibly difficult to replace. And here is my revenue keys is targeting $10 billion in annual revenue and 2 billion in net income by 2028. The foundations for this goal is the expansion of its digital footprint through Fastenal Management Inventory Programs (FMI), like FastWen, which provide essential demand data and embed the company within customer operation. This is reinforced by the rapid growth of high-value on-site locations. Next one is about the digital footprint, primarily driven by the deployment of weighted fast-bin and fast-win units. With approximately 26,000 new signs targeted for 2025, creates a deeply integrated supply chain that effectively locks in market shares, extending this outlook to 2026, pushing the install base beyond 160,000 units in the CapEx to accelerate its digital expansion, specifically funding FMI hardware deployments like FastBin and FastWen. These investments ensure the necessary resources to drive over two-thirds of revenue from its digital footprint while enhancing on-site efficiency. And then let's moving on. The overall capital goods industry is expanding due to the large-scale infrastructure investment and demand for advanced industrial technologies, which project to grow from $8 trillion in 2024 to $13 trillion by 2034 at 5% CAGR. McKinsey forecasts 88% AI and 29% generative AI adoption by 2025. Goldman Sachs projects a 165% rise in the data center power demand by 2030. The power and electrical equipment market is expected to rise from $265 billion in 2025 to $360 billion by 2030, an average increase of 6% by Yahoo Finance. And then we live in the quarterly data, which the net profit margin and gross margin slightly increased over time. And the recent news is new CEO Max Tunnicliffe was appointed as Chief Financial Officer. Next one is a recent 12% jump in daily sales, creating a competitive advantage. And the last one is excellent in financial discipline, demonstrated by strong cash flow and high ROIC over 30%. And let's looking in the consensus estimate. There's four analysts have a strong buy recommendation, 11 of its neutral views, and no one have a strong sales. The consensus target price is set at $44, which is above the current price of $41, implying a potential upside of 7%. Revenue growth projects to rise from 3% in 2024 to a robust 8% by 2027. And then looking at the deeply in revenue breakdown, with over 70% of total sales coming from large, stable contract customers. The company focused on increasing its daily sales rate (DSR) through market share captures and highlighting a successful diversification strategy. 47% is MRO and general, 30% is fasteners, and 23% is safety supply. Digital footprints encompassing e-commerce and Fastenal managed inventory (FMI) system. This shift is complemented by the strategic expansion of high-value on-site location, which Fastenal personnel and inventory directly customer site, lasting customer relationships that serve as the fundamental engines. Next, we have the FVMR investing framework, which overall fast appear attractive relative to 1,690 non-financial companies in the USA. For the fundamental, they have a best performance due to the high asset turnover, leading to a strong performance over peers, and moderately unattractive in the valuation, with momentum also moderately attractive, while the excellent risk in the net debt to equity ratio, the company beta has increased over the last 3 months to 1.5, which represent that company have a less cash after they pay back debt. And then look at the world-class benchmark, with profitable growth has been consistently ranked in the number one place since 2021. This is a world-class performance, while the profitability is excellent and has consistently remained in the top number one rank, and the asset efficiency has consistently ranked at number two. And on the other hand, expense control has a top ranking at the number one, which is the main driver of the overall profitability. In addition, growth has been ranked in line with the average. Expense direction and revenue growth have been volatile between the average. And then let's looking in our profit and loss statement, which revenue and net profit reach my key story. First one is reach 10 billion in 2028, and their net profit reach 2 billion in 2028, which related to my first story. And then the asset is inventory and net fixed asset slightly increased over the year by 2024. We moving on the liability and equity, which account payable, long-term debt, and other long-term liability still slightly increased from 2024. We did in cash flow statement, you can see the dividend increased slightly, so that make a dividend paid during net income increase. So the ratio from the cash conversion cycle, we can see the cash conversion cycle increased slightly a little bit from 2024, and payable deferral period is slightly decreased over the expected years. So we move on the revenue part. Here is increase from quarterly 12%, and I'm expected to 2025 will be 8%, and also for net profit margin have a bit increase. Here is about the free cash flow data, which is the change in account receivable, change in inventory, and less in capex, which also includes about change in account payable. Still have this estimated number because of our capex in Fastwin and Fastbin in the key story, the third one. And the FCFF, which is free cash flow to firm, is still very healthy for 1 billion in 2025, then 2 billion in 2029 estimate. And here is our relative valuation with fast appear over values at a significant premium based on the 2026 expected PB to our E multiple, which indicates that it could be overvalued. We can see the ratio of it is 12%, but ROE of it is 35%, which stand out from its peers, other countries. And the next one here is about the PEG ratio. Due to the negative forecast in EPS growth, which is 20 negative, the PEG ratio output is not meaningful. So to valuation and target price, here is the risk-free rate of 2.5%, and forecast a capital structure with around 10% debt to total capital. This result in the WACC and discount rate of 6.5%, and use a terminal growth of 2% and free cash flow to firm because Fastenal has significant capex for growth and has money left after repaying debt. So leading to a value of $47 per share based on the FCFF methodology. This represents a 14% upside compared to the current market price. And then moving on, my sensitivity analysis. In my sensitivity analysis, the optimistic case assumes the gross margin of 47% results in a target price of $48. And conversely, in the pessimistic case, the gross margin is assumed to be 43% at $45, yielding a value of $45 per share. The next part is for the risk. The economic factor and strategic executions are core risks, which a failure to successfully execute its key growth strategies could significantly slow its revenue growth. And Fastenal financial performance is strongly tied to the cyclical industrial economy, linking a drop in the PMI to lower sales volume and revenue. This correlation necessitates a reduce in revenue growth forecast of 5%. And the next one is intensely competitive, pressuring Fastenal selling price, which rival pricing or superior models could erode pricing power, causing the gross profit margin to decline from 45% to forecast 43%. The last one is supply chain disruption and cost volatility. In it results in the shrunken margins, a projected 30% negative operating growth, and an increased 180-day inventory conversion period. Okay, to wrap up it's all. So from the previous evidence, three key highlighting stories and the risk which I'm provide you in this presentation, equity valuation, and you should buy it right now. Then the next one, it's open for the question.
Excellent. Okay. First question comes from Momin. And he says, do you think that your weighted average cost of capital is a bit low, given the price to book is almost double its US peers? Two, what would be the main reason to buy now? So let's first talk about the weighted average cost of capital. Maybe you can go back to that slide.
Yes.
There we go. Yeah, talk about why. I mean, it is pretty low, but you may have some thoughts and reasons on that. So please explain.
Yeah, let's dive into the WACC calculation with cost of debt is 3.3% from my research in Refinitives, and our debt is 10.4, which I think that company doesn't provide more about debt, so they have a strong performance to pay debt. You can see from the previous that after paying the debt, they also have a cash left. So I think I can reduce the debt as a percentage of the total capital. So that's why the weighted average cost of capital for me is 6.5% here.
And I noticed that the beta of the company was kind of rising recently. You showed in the FVMR page. And right now you're using 0.75 or 0.8 for your beta. What's the risk or what's the possibility that your beta is too low and it should be, let's say, 1 times?
We can see the quarterly data, right? That the beta is 1.5, but when we see it just rising by the quarterly. So I'm pick the 0.8 because I'm put in it in range in the long term and try to normalize with the previous quarterly data too. So I didn't pick 1.5.
Okay, so Lee has a question. Do you expect that the recent sales increase in fasteners category can be sustained through 2026?
Actually, of course. I think so.
Okay. And what about Fastenal's competitors such as Granger and MSCI Direct have adopted their own versions of the on-site model? What are your thoughts on the innovation, and is Fast doing enough to protect its market share against tough competitors coming after it?
Due to the FMI projects of Fastenal can make a market proportion which can be competitive. Hard to competitive is because FMI is a competitive advantage.
Okay. And here we have, for relative valuation, it looks quite overvalued. How can you incorporate this relative valuation to assess whether there's still some upside? Like, what is your opinion about that?
In my opinion, I will go to the PEG ratio first. So we can see the last year at the 2024, which is also be negative in EPS growth. For this will make a negative in my expectation. So the fast get the negative EPS growth. That's why the forecast is might be can forecast it in my opinion. So move into the PB to ROE ratio. Although the fast have the PB ratio over USA, Asian ex Japan, and world, but they still have a very high ROE at the 35%. So it make a fast is very overvalued in both relative valuation.
Surya asked, you mentioned that 70% of revenue comes from the non-fastener product line. Is there any key products that are contributing to this product line?
Let's move into the revenue breaks. So actually, the 70% of it derived from non-fastener product line. It actually lead by other product lines such as MRO and janitorial. Yeah, might be the at the 47% of sales follow here too by the safety supply.
Okay. And Arush says on-site growth is strong, but newer companies that they sign up may have lower returns because they've already onboarded the high quality, biggest customers. What's the risk that the returns of the company will fall over the next few years?
Over the next few years, I think companies still, let's move on the risk page here. Like if they are very competitive, so the risk of the company is about the supply chain disruption and cost volatility, which is the number 4 risk, which my forecast will change if there are that risk occur as a project 30% negative operating growth, yeah, and increase 180-day inventory conversion period in
So
my forecast.
how does it feel to finish this presentation? Congratulations.
Thank you. I'm actually prepare myself a lot of time with uh, Lee and moments to correcting my presentation. And I would like to thank you all of you guys that give me a chance to make a presenter here today
Yep.
for my recommendations.
And how would you describe the transformation that you've gone through from when you started on day one to where you are right
Oh,
now?
I'm think the big transformation is about my view about the valuation because when first time I'm done the project in my bachelor degree about the valuation, I'm just done only the overview. I can't deep into detail, and my transformation is I can more clearly deep into the detail and in the FVMR and world class benchmark is a tool that can make me easily understand the point of the company in the world
Yep.
and its industry.
Fantastic. Well, congratulations on that. I'm gonna
Yes.
take you out of this now because we got to wrap up and get on to our next presentation. But you did a great job, so congratulations.
Yes.
All right. Well, that was pretty impressive. You know, he started from zero. Putti-san has done a great job with that. Remember, if you want to build a competitive advantage in company valuation, join us in Valuation Masterclass